Hello again, everyone. It's 10 o'clock in the morning, Chicago time on Tuesday, February 7th, 2023. I'm John Kosar from Asbury Research, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe will be the most influential to U.S. stock market direction over the next several weeks and potentially into the second quarter of this year. Let's follow the money. The last time that I was with you for your Daily 5 was on January the 7th, and at that time we said that the S&P 500 was testing major resistance at 4,000, and our Asbury 6 tactical model, which we're going to get to in just a moment here, was negative. So that was ideal situation for the major downtrend to resume if it was still valid. Here's what happened. On January the 23rd, we actually broke out higher. We broke out up above the 200-day moving average, which is a major trend proxy, and we also closed up above the 2022 major downtrend line, which was drawn from the January 4th high in 2022. Right after that, we went straight up and took out this DS1 to DS13 highs, these two highs. And now we're settling back a little bit as everyone is focused on the Fed again. But this is a major bullish breakout. As long as we hold this underlying level here, 39.59 to 39.48. So let's call it 39.50. It represents the intersection of the 50-day, the 200-day moving average, and this major downtrend line from 2022. The 50-day is a widely watched minor trend proxy. Those are the parameters. On the top side, the next formidable resistance level is up here at 43.25. That represents the August 16th peak from last year. That was another test of that trend line that actually held. So that's the next place we go on the upside, assuming that we hold this 39.50 level as support and keep the major breakout valid. Number 2, the Asbury 6 has turned positive. Asbury 6 is one of 2 models that we have that indicate what market internals are. We built the Asbury 6 because it's too hard to try to determine what the condition or what the character of the stock market is anymore by just looking at the S&P 500 and maybe 1 or 2 indicators like volume. You need more. So we built the Asbury 6. We back tested all of my favorite tactical indicators throughout my career, probably back tested 15 of them. And we ended up with these 6 that work really well together, kind of like a team, like a hockey team, where if one guy falls down, the other guy comes to try to pick up his check. This is the same concept here. Every indicator gives false signals sometimes. There's no perfect indicator. We found 6 that do a really good job. If 1 or 2 are giving false indications, the other 4 will show the right direction. It keeps us focused on the internals of the market, which are actually making prices go up and down, and not the day-to-day gyrations of the S&P 500, which are largely due to algorithmic trading, all the computerized trading back and forth, which is by some accounts about 80% of the daily volume right now. So right now you can see all 6 of these are green. These are the dates that these all turned green. And by the way, only one of these 6 has to do with the price of the S&P. It's the rate of change in the S&P 500. The other 5 on purpose are things that can't be immediately affected by the herky-jerkiness of the S&P 500 day to day. You've got things like investor asset flows, corporate bond spreads, market breadth. So all 6 of these are green. 4 or more are necessary in the Asbury 6 model to indicate a directional signal. So 4 or more turn green on January the 11th. The S&P 500 has risen by 6% since then, and that turn to positive in the Asbury 6, it actually preceded this bullish breakout that we had on January 23rd. So it gave us a little bit of an early warning that the market was getting stronger and it was getting ready to break the major resistance and make a major bullish trend change. So here's our chart. You can see on January the 11th, is the last time that they turned green, that the Asbury 6 turned green. As long as 4 or more of these metrics stay green, it's going to indicate that the market is internally healthy and amid favorable conditions to turn higher. This indicator is particularly valuable when we have 1 or 2 days where the market makes a violent reversal. We had one over the past couple of 2-3 weeks where the market was up. Then we had 1 or 2 days where the market was down really hard. Financial media was all over this as the top. The market went too far. The Asbury 6 didn't budge. It stayed green. That gave us the conviction to hold on to our longs, and it turned out to be a really good decision, and it paid off for us. So now we'll go to number 3, semiconductors. Market leader targets a big advance. One of the reasons that the rallies that we had last year, we had a big rally off of the June lows. We had another big rally off of the October lows. The reason that those didn't take us right into a new uptrend is because there was no leadership. Typically, in a sustainable bull market or a sustainable move higher, you need leadership, and it usually comes from tech or semiconductors, and sometimes it'll come from small cap. We didn't have any of that up until recently. But look at the SOX. The SOX is, to me, the tip of the spear for technology. SOX typically leads tech typically leads the broad market. So what happened here is we had a major bullish trend change by going through the 200-day moving average in the PHLX Semiconductor Index about the middle of January. Shortly after that, we broke this trend line drawn off of the August 15th high down through the DS13 low. That gave us an inverse head and shoulders pattern. This pattern targets an additional 23% rise to 3750, way up here, up above the March 2022 benchmark high. That will remain valid as long as we hold support, major support. Major support is now at 2843 to 2720. So basically, those resistance levels that we broke are now support. As long as we hold 2843 to 2720, this is a valid breakout, and it projects a big move higher. If the SOX goes up that much higher, it suggests that that this major bullish trend change that we just made in the S&P 500 is going to hold, and we're going to see higher prices maybe into the middle part of this year. Number 4, investor sentiment. Major market bottom at the October lows. Back on October the 18th, I did a Your Daily 5 that was entitled, Get Ready for a Great Buying Opportunity. One of several reasons that I looked for a great buying opportunity on October the 18th was right here, the investors' intelligence data, which actually Asbury Research is one of the inputs of many inputs from various analysts around the country into this particular survey. But it was coming off an October 7 bottom, and as I went across this chart, I saw every other least bullish extreme, like this one on October 7th, were major lows in the market. March 2020, that was the COVID low. Jan 2019 here, March of 2016 up here, and then we had September of 2011 and Sep of 2010, all big lows. That suggested to me that we were making another multi-quarter low in October. So since then, this indicator has kind of moved back into middle ground here, but it's still moving higher. That suggests to me that there is still room for more bullish sentiment to come into the market and take this back to these most bullish extremes, which is where you start to look for a top. So again, this is an indicator that we looked at months ago that still has directional implications higher over the next 1 to several months. Finally, number 5, market sectors. The SEAF model favors technology and consumer discretionary. Why is that important? Because these are risk-on sectors. First of all, our SEAF model. For those that are not familiar with SEAF, either through Asbury Research or through StockCharts.com, the SEAF model is a model that I built years ago. And it follows the asset flows around the 11 sector spiders to show us where the money is going and where the money is coming from. Why use asset flows? Because they're more sensitive, they're faster, they're more sensitive, and they move quicker in telling us when these trends start and end. 5 years ago, sector rotation was slower. The trends would last a quarter or two. Give you plenty of time to get in and get out. These trends are a lot more staccato now. They're a lot more abbreviated. They tend to be, they accelerate quickly and they decelerate just as quickly. So what we found is instead of waiting for the relative performance to show up on your price chart, we're following the money. The money moves first, and that actually makes the chart look like you'd want it to look if you want to overweight that particular sector. So right now, there's more information, by the way, on the SEAF, so you can understand it better if you go to asburyresearch.com and go to models and find SEAF, and you can answer some questions you might have. How does this work? Right now, the important thing I want to get across to you is the 3 best sectors in terms of their overall score. And we measure asset flows in 3 different time frames: trading, tactical, strategic. 3 different time frames. Right now, the 3 best in terms of assets in: technology, communication services, and consumer discretionary. All 3 of those are risk-on type of sectors. The 2 worst sectors, which means there's asset flows coming out, are from healthcare and energy. So we want to be looking for opportunities in tech, communication services, and consumer discretionary, and avoiding these on the bottom, avoiding healthcare and energy, because effectively, broadly speaking, there's money coming out of healthcare and energy and going into those top 3. This chart shows them a little more graphically, and you can see our favored with a score of 3 to 15 are tech, communication services, discretionary, financials, and materials. Of those, the 2 SEAF model signals are highlighted in kind of a fluorescent green here. The neutral ones are industrials and real estate, and the ones to avoid, which have a score of 25 to 33, are utilities, staples, healthcare, and energy. So there you have it. It looks like the market is in the midst of a major bullish trend change. The Asbury 6 is telling us the market internals are strong. The semiconductors are showing leadership and suggesting this move could turn out to be a lot bigger than it is right now. And finally, you're seeing the money flow starting to go into these risk-on sectors, which is exactly what this emerging bull market needs to keep going. So there it is. If you like our approach to markets and investing, I invite you to visit our website at asburyresearch.com.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.